Welcome to RBC's Markets in Motion podcast, recorded June 2nd, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, we're modestly revising our year-end 2025 S&P 500 price target, taking it up 3% to 57.30 from 55.50. Our valuation and earnings models drive this number. Second, we view sentiment as the main risk to our call. Even though it's been melting up in recent weeks, our sentiment model, based on AAII net bulls, is still the most constructive one in our price target toolkit. And our analysis of S&P 500 moves off the lows of major post-GFC drawdowns indicates that the index could have more room to run through year-end 2025. And third, we review the case for and against small caps, which were in focus in our meetings last week. We remain neutral as small caps have been de-risked to a greater degree than large caps, making an underweight unwise in our opinion, but the conditions for outperformance seem elusive. If you'd like to hear more, here's another 6 minutes. While you're waiting, we need a favor. The Extel survey, formerly known as Institutional Investor, opens today. If you found this podcast helpful, we'd appreciate your support in the portfolio strategy category. Last year, we were honored to rank number 3 in a tight race our first time in the top 3. We think our podcast listeners did a lot to help us get there, and we'd appreciate your support again this year. Now let's jump into the details. We'll start with takeaway number 1. We're lifting our year-end 2025 S&P 500 price target to 57.30 from 55.50. Our new price target reflects our belief that the stock market is on a slightly better path than the one it was on April 4th, when we cut our target for the second time in 2025, but not back to where it was in January or even mid-March when we cut our target for the first time. As a reminder, we see our price target as a navigational tool, but more of a compass than a GPS, which we revise when new information becomes available, similar to how most stock analysts revise their company-level forecasts throughout the year. As always, the price target itself is driven by the math of our models. Following the latest round of updates, the median outcome of the 5 models we used is 57.30. The range of outcomes remains wide, from roughly 5,500 to 6,400, highlighting the high degree of uncertainty that persists. We see 6,400, the output of our sentiment model, as our bull case if our official target ends up being too conservative. For a bear case, 2 thoughts come to mind. The first is that we suspect a more negative outcome in the stock market could take the S&P 500 down to the recession lows of the third tier of fear at some point before the year is up. We estimate that to be in the 4,200 to 4,500 range. Another reasonable bear case comes from our valuation model, which suggests that the S&P 500 could end the year a little above 5,000 if inflation settles out in the low 3% range, the Fed doesn't cut, 10-year yields end the year at 5%, and S&P EPS comes in flat with 2024. Meanwhile, the 57.30 median outcome that serves as our official year-end 2025 price target is the output of our base case valuation and earnings modeling. We project a target trailing PE of 21.5 based on RBC House views on key macro variables and our analysis of the relationship of these variables with PEs going back to the 60s, along with our own 2025 S&P EPS forecast of 258. For the base case, these models bake in inflation in the upper 2s, 3 Fed cuts starting in September, real GDP of 1.3% for the year, margin contraction more significant in the back half of the year than in 2Q, and some relief on interest expense. This is a better macro backdrop than the severe stagflation scenario we used in early April, but it's not as strong as the set of assumptions we used in January. This model is telling us that current pricing in the S&P 500 already reflects the step-up improvement in macro fundamentals that occurred 2 weeks ago, when the U.S.-China trade war experienced a significant de-escalation and has left us feeling rather neutral on the direction of stocks through year-end. While the average outcome of our 5 models would get us to 5,900, we are more comfortable using the median, since 2 of the models in our targeting process that are most constructive are currently in flux. One of those is our earnings yield gap model, which is still in a constructive range for stocks right now, but would flip into a negative range if 10-year yields move to 5.3%. The other that's misbehaving, which we're more worried about, is our sentiment model. That reflects the idea that rebounds off extreme levels of bearishness tend to be powerful, but this indicator, which is based on AAII net bulls, has been moving up rapidly in recent weeks, and it's signaling less robust forward returns than what we saw in early April, when it was 2 standard deviations below the long-term average. In just a few weeks of recovery, this indicator is already back to 1 standard deviation below the long-term average. We're keeping a close eye on it to see how fast it moves up. In recent years, a move to one standard deviation above the long-term average has been a reliable signal that the stock market is due for a pullback. Note that we haven't issued a 2026 price target yet, but we have started to plot out some scenarios for next year using our valuation model, the same model that produced our 5730 price target for 2025. That work points to fair value in the 6,200, 6,800 range for the index at year-end 2026. Moving on to takeaway number 2, and we'll do this one quickly. Rebounding sentiment is the main risk to our call. Though we are worried about how quickly AAII net bulls are rising, we also recognize that a continued melt-up in stock prices due to rebounding sentiment is something to worry about. We spent some time last week studying the rebounds in the S&P 500 off the lows and the major post-GFC drawdowns, those that were 10% or more. Excluding the 2020 COVID recession, when we looked 9 months out, roughly the amount of time it would take you to get from the April 8th low to December 31st, we found that the rebounds averaged 26%. That suggests that by the end of the year, the current rebound could end up around 6,300. There was a fairly wide range of magnitudes in these rebounds, with the weakest coming in at 17% and the most powerful coming in at 35%. At the mid-May high, the 2025 rebound totaled 20%, already in range. And we'll wrap up with takeaway number 3, while we're neutral on small caps. In terms of performance, small caps have stabilized relative to large caps. Points in favor of small cap include evidence of greater de-risking on our positioning data per CFTC, as well as our valuation data, along with stronger EPS forecasts in small cap and better earnings revision trends in small caps. We see 2 problems, however. The first is that economic tailwinds seem elusive. We're keeping a close eye on non-farm payrolls and ISM manufacturing, as a ramp-up in either tends to be associated with small cap leadership. The second problem is that our rate strategist doesn't expect the Fed to start cutting until September, and the financial community generally seems to be dialing down and pushing out Fed expectations. This is important because cuts tend to spark small cap leadership, though it doesn't tend to be sustainable unless it is also associated with a recession and a fierce economic recovery. That's all for now. Thanks for listening, and don't forget to vote.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.